Well, it's so volatile that we have $100 billion options market that's formed on top of our stock. So our company went from $1 billion market cap to $100 billion market cap in 4 years. Our options market went from zero to $100 billion in 4 years. Our volatility went from 20 or 15, very low vol, to 120. Okay, you can look at that as a negative or a positive, but here's the positive. 120 is like hot money. It's like fast RPM. It's only risk if the volatility comes from doing risky things, if it comes from gambling or doing stupid things. If I go into a casino and I play a game where the odds are against me and I'm winning, well, I'm also going to be volatile, but I'm volatile by taking risk, maybe stupid risk. But if I build a centrifuge or a flywheel and I spin it really hard, I might be volatile. It might look volatile to someone that doesn't understand polar geometries or doesn't understand physics, but it's not risk. It's just a machine that's creating motion or kinetic energy. So when MicroStrategy created that 120 vol, and to be clear for your listeners, to put that in perspective, if you stacked up all of the S&P 500 companies, 120 vol would mean you're the number one most volatile company in the S&P index. Okay.
And just to oversimplify here, or not even oversimplify it, but to state it as plainly as possible, it means that you are doing wild swings up and wild swings down very rapidly.
Yes. Yeah.
In price.
We're oscillating. We're oscillating, and maybe in an unpredictable way. It's like, like if I do this with a piece of balsa wood, it's like a kid's propeller toy, like it's a little toy, maybe those things that scare away the mosquitoes at your tropical barbecue. If I do this with a 5-pound weight, it's a weapon or a weed eater or a lawnmower or something, right? I mean, it's a piece of farm machinery. If I do this with $40 billion, it's a turbine. It might move your jet across the Atlantic Ocean, right? There's 15,000 pounds of thrust in a jet engine, but it's more like a turbine.
Why is it a turbine? What is the, God, this is where I don't know physics, but what is the energy output? Is it that money is moving from one person to another? I mean, that's all I think about when I think about volatility. You get one guy panics, he bought high, he sold low. And then the next guy comes in and buys low and sells high. And so one wins, one loses.
If I give you a stock option on the dollar bill and I say, Tom, the dollar bill is zero volatility, but I'm going to give you an option to buy 10 more dollar bills for $1 for the next year. Well, what is the option worth? It's nothing, right? Because the dollar is going to be worth $1. I mean, so a stock option with no volatility is worthless. The Black-Scholes equation is the conventional way to value a stock option. Suffice it to say, when the volatility goes to 15, there's a little bit of optionality. When it goes to 60, there's a lot of optionality. When it goes to 120, the option's exploding in value. And let me give you the practical value of it. If you had $1,000 or $1 million, let's say $1 million, you have $1 million in the bank. Well, with zero volatility, you can probably get paid SOFR. So you're getting paid 4% to take the risk of holding dollars in the bank. 4%. When you hold that money in the S&P index with the volatility of the VIX or 15, you might get paid 12 to 15% interest to take the risk of holding one share of SPY, the index. When you hold a share of Bitcoin via IBIT or a Bitcoin, the volatility is 60. You might get paid 70%, 80% to hold that $1 million in Bitcoin, and you're taking the downside risk, but you're getting paid that call rate. When you hold a share of MicroStrategy, if you were holding $1 million of MicroStrategy and you were selling the calls at the market with 120 vol, you could get paid 200% annual interest. You might not even know what it is. Like, you don't know what Bitcoin is. You don't know what MicroStrategy does. All you know is that if it's not going to zero in the next 12 months, someone will pay you 200% interest. So your break-even point is 6 months, right? It's like, if I can hold it for 6 months and it doesn't go to zero, I'm getting paid 200%. I'm getting paid my money back. My break-even point is 6 months on something I don't understand. There was an options trader on television today. He was saying, yeah, I mean, none of them really understand what MicroStrategy does, by the way. Like, understanding what we do takes an hour. Understanding what Bitcoin does takes 100 hours. They don't know that. Here's what they say. Well, the share of stock's about $400, and we just sold a $700 call option for $180 for 1 year. And so someone's going to pay us $180, and the worst case is MicroStrategy rallies and we'll double our money and we'll get taken out of the trade. But we're thinking that whatever it'll do, unless it gets cut in half immediately and goes south from there, even if it does get cut in half, we still made money, right? So this is indicative of your point, which is when there's enough performance and enough volatility, you don't just attract the smart money. You can attract the Bitcoin maxis, the people that have spent 1,000 hours, and their view is, hey, MicroStrategy's 2x Bitcoin, I'll buy it. Well, you might also attract the investors that say, hey, I don't know what it is, but it's up 120% a year for the past 4 years, so I might as well buy the hot thing. But you may attract the volatility traders.